When is a C corporation best for small businesses? I'm a business attorney, and I recently had a conversation with a client where I recommended a C corporation. And admittedly, that's pretty rare because most of the time, small businesses should be an S corporation, and sometimes an LLC. But it is rare to be a C corporation, and here's why. C corporations get taxed twice, once at the corporate level, once at the shareholder level or the owner level. So in other words, let's say a corporation, a C corporation, has 10 million in revenue, 9 million in expenses, and so the remainder is 1 million in profit. When C corporation has 1 million in profit, it must pay income tax on that profit. Now let's say that corporation passes that profit on to shareholders. The shareholders then have to pay income tax on that money received. So in a C corporation, profits are taxed twice, one at the corporate level, one at the shareholder level. So usually it's better to have an S corporation. In an S corporation, the profits from the company flow right through to the owner. They're not taxed at the corporate level, and they're only taxed at the shareholder level. So as you can see, most of the time, from a tax perspective, an S corporation is advantageous. But there are a couple times when a C corporation is best. That's what I'm going to talk about here. First off, there are some things that a C corporation can deduct that an S corporation or LLC cannot. Obviously, a company can always deduct expenses for the employees who are not shareholders. But in an S corporation and an LLC, you may be limited in whether you deduct certain sorts of fringe benefits, insurance, and some of the other expenses that you may have. But in a C corporation, you're permitted to do that. So that's one example. That usually isn't the major reason, though. This is the major reason. A C corporation may be generating so much money that it's actually never going to move that money into the shareholders. Let's talk about that. It's often called retained earnings. So if the C corporation gets money and retains that money, sure, they'll have to pay tax on it once, but they're not passing it along to the shareholders. What often happens is the shareholders are not interested in pulling the money out and getting taxed on it. They would rather leave that money in the company, which increases the value of the shares, and the company reinvests that money in other business opportunities. That was the scenario I ran into recently. My client has a business and doesn't need the money from the business. He's very frugal. He does not live a lavish lifestyle. He keeps things simple. He's a minimalist. And as a result, he doesn't need a whole lot of money to live. And he also has some other sources of income from a job. So this client of mine has these business ventures, and his desire is to help people with them, help employees, help friends of his who want to start companies, and really create a community that fosters supporting each other, reinvesting and helping people, and making a big difference. That's what gets him excited. That's what gets him out of bed every day, along with what he's doing in his other job. But the bottom line is, let's say you have a corporation and you're not going to need the profits distributed to you. Well, rather than having an S corporation where you have to pay tax on all the profits at the shareholder level, you can use the C corporation level. Yes, you're going to have to pay some tax, but it's not as much as if it were passed along to you. And then once those profits are sitting in the company, those earnings, they're retained for future reinvestment. So One of the reasons a business owner might want to have a C corporation is because the owner doesn't plan to pull a lot of the earnings or profits out of the company. The owner wants to change the world, make a difference, and use those profits to start new businesses and take advantage of new opportunities. And in that case, there's going to be lower taxes in a C corporation than there would be in an S corporation, because the tax or the profits are not following down to the shareholder, who then has to pay a higher rate. And you might say, but I thought a C corporation gets taxed twice, once at the corporate level, once at the shareholder level. That's normally true. But if you never distribute the profits to the shareholders, then they're not having to pay tax at that level. The profits sit in the company and get reinvested and reinvested. Now you might say, well, eventually, what happens? Well, usually people die. In fact, we all die. And at that point, their shares in the company go to whoever they want to pass them to in their estate plan. And usually, the recipient of those shares gets them in what's called a stepped-up basis. That's a legal or tax term, and I'm going to explain it to you, but the bottom line is they don't have to pay tax on the shares that they've received. And if they sell those shares, they don't have to pay tax on that. It's essentially considered a gift. So here's what stepped-up basis is. Let's say that you put $1 million into a company. That company has a basis of $1 million. And so that's what maybe you spent on the shares of the company. 1,000,000 shares for $1 million, $1 per share. All right, and you're the only owner of the company. So you own the whole thing. The company now has $1 million in cash in it. You have 1,000,000 shares. Let's say, though, that the company generates profits over time. And let's just say it earns $9 million in profits over the life of the company before you pass away. And it has to pay tax on that $9 million, but it keeps that $9 million as retained earnings. Well, now the company has your million and the $9 million in retained earnings. That's a total of $10 million. So that company now is worth $10 million. In other words, the shares that you paid $1 million for are worth $10 million. So there is a difference of $9 million between what you paid for the shares and today's value of the shares. Now, normally, if you sell those shares, you're going to have to pay capital gains tax on the money when you get it. But if you transfer that $10 million in shares, let's say to your child gets those shares with what's called a stepped-up basis. So instead of saying the basis is $1 million, which is what you paid, the basis becomes $10 million, and there's no tax bill associated with that. It's a huge loophole, if you want to call it that, in the tax code, or it's a huge feature, whichever perspective you want. The idea, though, is that a certain amount of money can be passed on to heirs in your lifetime tax-free. And the heirs get shares in a company with stepped-up basis. So they don't have to get it and then pay a huge tax bill on it. You might say, well, why does Congress allow that? Shouldn't that be changed? Well, here's the argument against it. Let's say you inherit $10 million in shares from your grandpa. And let's say you decide you would like to hold on to those shares and maybe pass it on to your kids. Well, if you immediately owe a tax bill on that, and let's say your tax bill is $4 million out of $10 million, you're going to have to sell shares because you don't have that kind of money sitting around. So the idea is we want citizens to be able to pass on at least a certain amount of inheritance without the children or grandchildren having to sell part of the inheritance in order to pay the tax bill for that. That's why the stepped-up basis is available. So, going back to the big question here, when would a business owner want a C corporation? Well, if they're not going to have to pull a lot of money out of the company and they plan to just accumulate wealth or retain earnings, keep all of those profits, and then pass that on or donate something to a charity, that's a great example of when a C corporation will cost less for the owner. The owner will pay less in taxes with a C corporation than the owner would in an S corporation or an LLC taxed as a sole proprietorship. I'm Aaron Hall. I'm an attorney for business owners and entrepreneurial companies. My goal is to help business owners avoid problems, minimize taxes, stay out of trouble, and focus on what's most important to them, running a thriving company. If you'd like to learn more about how to avoid problems in your company, I have a resource available. It's available at no charge. You can find it at aaronhall.com/free. If you go there, you sign up and you'll get a PDF with some of the common legal problems faced by companies. You'll get some videos with me explaining how you can save money on those. There's no charge for that. Coming up next, I'm going to be talking about how can you avoid problems with employees and lawsuits that result from them. In fact, the next 2 videos coming out will talk about what are some simple steps you can take to avoid expensive legal problems related to disgruntled employees who sue for wrongful termination or some other false allegation. We'll also talk about what do you do if there's an allegation of sexual misconduct in the company, like an employee having sexual assault or sexual misconduct towards another employee. What do you do if that happens? And how do you prevent that from happening in your company? If you'd like to see those videos, subscribe to the channel. I'm Aaron Hall. Thanks for joining me today.